Welcome to the Deep Dive. Today we are cutting straight through the noise, getting right to the core of the Q3 fiscal 26 earnings for Sprinklr. That's ticker CXM.
Yep.
The results dropped pre-market on December 3rd, and they really told a fascinating story about a company in the middle of a major shift.
Exactly. And for anyone following the software sector, this wasn't just another earnings call. This is a really big public update on their whole multi-year transformation strategy.
The one from CEO Rory Read.
That's the one.
Yeah.
And look, we weren't really looking for massive growth acceleration, not yet anyway. What we were looking for was validation.
Validation that the plan is working.
Right. Is this whole pivot to profitability, to, cost control, is it actually taking hold?
Okay, let's get straight to the numbers then, because the market reaction was, well, it was pretty clear. They delivered a huge upside surprise.
And it all came down to one thing.
Financial discipline.
It was a margin story.
Yeah.
Pure and simple.
So let's start at the bottom line. Non-GAAP EPS came in at 12 cents.
12 cents. And you have to remember the consensus was somewhere around, 9 cents?
About 9 cents, yeah. So that's a 33% surprise. I mean, that's a huge beat. And it's up from 10 cents a year ago.
That's the kind of margin execution that gets investors to sit up and pay attention fast.
And the revenue number, well, you said it wasn't the main event. It was still pretty solid.
Oh, for sure. They reported $219.1 million. That was a good 4, maybe 5% beat against the consensus of 211.
So 9% year-over-year growth.
Right. But again, if there is one central theme to this deep dive, it is that profitability expansion. The non-GAAP operating income just exploded to $33.5 million.
Which gets them to that 15% non-GAAP operating margin.
15%. That is up 4 full percentage points from last year. That's massive.
So that 15% margin, that's the new foundation for the entire Sprinklr story. But hold on. If the financials are so tight, why is the most important part of the business?
The subscription revenue.
Exactly, the sticky subscription revenue. Why is it growing so much more slowly?
And that is the absolute critical tension here. You've got total revenue growing at 9%, but subscriptions, which are 190 million of that, they only grew at 5%.
Okay, so what does that gap tell us? What's going on under the hood?
It tells us they're doing the hard part, the painful part of the strategy. Management has been really clear about this.
They're prioritizing.
They are actively prioritizing the high-quality, high-margin enterprise deals. And at the same time, they are getting rid of the lower-quality accounts that just don't fit the new model.
So they're trading some of that top-line speed for margin quality.
That's it, exactly. And while 5% growth feels slow, you have to remember they've been fighting against renewal headwinds for 2 years now. So for them, stabilization is actually a win.
Okay, let's shift to the balance sheet. Because a transformation like this costs money. How's their cash position looking?
They're sitting on a fortress. They generated $15.5 million in free cash flow this quarter alone.
And the total cash on hand.
$480 million in cash and marketable securities. So this efficiency means they can fund all this R&D and transformation without any stress. Gives them a ton of options.
All right, let's talk bookings. This should be our crystal ball for what's coming next. The total remaining performance obligations, or RPO, it was actually down 5%.
Yeah, and that number, that usually sends a shiver down an investor's spine.
It sounds terrible.
It does. But you have to read the fine print here. Management was really quick to jump on this and provide context.
Okay, so what was the context?
They said last year's Q3 RPO number was kind of artificially high because of some really large one-off deals and just weird timing.
Timing issues. I mean, come on. That's the oldest excuse in the book for a shrinking pipeline, right? Why should anyone believe them?
Look, it's a fair question. But we have to look at the metric they pointed to, which is a better one anyway. Current RPO, CPO.
And that's the revenue they expect to recognize in just the next 12 months.
Right. And CPO was actually up 3% year over year. Now, if demand was truly collapsing, both of those numbers would be down sharply.
So the fact that the near-term number is growing, even a little, suggests it's not a demand problem. It's more about the length of new deals or just noise from last year.
I think so. It's the more honest leading indicator right now.
But the real insight into the quality of their business came from a different metric, the one about their biggest enterprise customers.
This is where it gets really interesting. They have 145 customers with contracts over $1 million.
Okay.
And while the number of those accounts didn't shoot up, the revenue they're getting from that cohort, that was up 9%.
And here's the proof of that quality. The net dollar expansion, NDE, for that group was 113%.
That is the validation point. For you listening, 113% NDE means for every $100 they got from their most important customers last year, they're now getting $113 this year.
So they're not just sticking around.
They are actively buying more. That one metric is proof that this strategy of focusing on the big fish is absolutely paying off.
Okay, let's pivot to the strategy behind all this. CEO Rory Read has framed this whole fiscal year, FY26, as a transition year.
Right. He's saying they're moving from phase one, which was all about optimization, cutting costs,
Into phase two, execution and transition.
and he was careful to point out that phase two will stretch into fiscal 27.
So he's managing expectations.
100%. He's telling the market, don't expect a miracle overnight. The focus is on building a durable, sustainable foundation. You know, the kind of foundation that supports a 15% margin.
And the main engine for this is an initiative they call Project Bear Hug.
Project Bear Hug.
I mean, that name, it sounds like something from a military drill, or maybe just painfully earnest. What on earth is it?
It's memorable, I'll give them that. It's all about deepening the relationships with their top 700 or 800 customers.
Which is where most of the money comes from.
It's where 90% of their revenue comes from. And the CEO even brought up Lou Gerstner's turnaround of IBM decades ago.
Wow, okay. Comparing yourself to Gerstner at IBM is a bold move. What does that tell us about what's changing inside Sprinklr?
It tells you this is a culture shock. Gerstner forced IBM to stop focusing on internal product silos and get back into the field with customers.
Make the customer the boss again.
Exactly. And Bear Hug is meant to do the same thing, forcing sales, service, product, everyone to work together for their biggest clients. And they said the early results are good.
Good how?
It's not just about upsells. They're actually turning around negative renewal situations. They're stopping the bleeding first and then expanding the deal.
And this all plays into their core product message, right? That they're this AI native unified CXM platform.
It's all about the unification problem. They're selling the ability to see the customer's voice across every single channel. Social, support, commerce, you name it.
Giving a full 360-degree view.
Right. They argue that their competitors, who are maybe only strong in one area, they just can't aggregate all that data. Sprinklr's AI sits on top of this massive unified data lake and can give context and automate responses instantly.
That all sounds great in a press release. But did they give a real-world example, some actual ROI?
They gave a great one, a big expansion deal with a Latin American bank.
Okay.
By putting in Sprinklr service and insights and using the AI automation, the bank saw a 35% increase in case deflection.
Meaning the AI just solved the problem, no human needed.
Yep. And 50% faster handling times when a human was needed. They even reported a 500% boost in agent productivity.
That's a huge ROI.
It's massive, and it locked in a new multi-year deal for them.
And this whole execution story also extends to the C-suite. They just brought in some heavy hitters.
They really did. A new CFO, Anthony Coletta, who comes from SAP, the deep enterprise finance experience, and a new Chief Product and Strategy Officer, Karthik Suri.
What's the signal there?
The signal is that they're dead serious about tightening up execution for phase two. They're bringing in the seasoned enterprise pros to make sure this thing stays on the rails.
Okay, let's look forward then. Management was obviously confident enough to raise their guidance for the rest of the year.
They were. The guidance raise was pretty meaningful. For Q4, they're projecting revenue between $216.5 and $217.5 million.
And that's above the Wall Street consensus.
Comfortably above. The street was down around 210 to 213, and the EPS guidance, 9 to 10 cents, also beat the 8 cents the street was looking for.
What about for the full year?
They raised the full year guidance too. Revenue now expected between 853 and 854 million, and EPS between 43 and 44 cents.
But they did add a little bit of caution in there.
A little bit, yeah. They noted that they were still investing heavily in AI and R&D. So, for example, cloud costs are actually going to tick up a bit because of these new AI products.
So it sounds like they're being very careful not to declare victory too early.
Precisely. The CEO kept saying the transition phase will go well into fiscal 27. They want to see a string of good quarters Q4, Q1, Q2 before they officially say the company is in the acceleration phase.
It's a prudent approach, is what you'd want to see.
Exactly. It's what sophisticated investors want from a management team in the middle of a pivot.
So how did the market react? What was the immediate verdict from the street?
The reaction was fast and it was positive. The stock jumped about 7.3% in the pre-market.
That's a strong signal of approval.
A very strong signal for the beat and the raise and the volume. It spiked to about 5 million shares, which is 3 or 4 times the daily average. So yeah, investors are rewarding the execution.
Let's put this in context. How does Sprinklr stack up against the rest of the software world?
And this is where the skepticism still hangs around. Sprinklr has badly underperformed the broader software sector. You can look at the IGV ETF over the last 3 months, 12 months.
It's also lagging the S&P 500 this year.
Right. So while this report is great validation of their cost control, that 15% margin is fantastic, the market is still deeply skeptical they can get subscription growth moving again, at least compared to their faster growing peers.
So the market is basically saying, we love the new profit floor, but you're still a value stock until you prove the growth engine isn't broken.
That's a perfect way to put it. And you see that reflected in the analyst price targets, which are all clustered around $10 to $11.
Suggesting there's a lot of upside if they keep executing.
A ton of upside. But they have to prove that Project Bear Hug and the AI platform can bring in new enterprise logos, not just expand existing ones. That's the next chapter.
Which brings us to our final segment. We're going to pitch an outrageous but plausible trade idea based on the data we've just gone through. And of course, this is not investment advice.
This is purely for analytical discussion. But the data here points to a really clear divergence.
Which is?
Sprinklr has successfully pivoted to profitability, but its stock is still lagging the whole software basket, the IGV.
And the bet is that good execution eventually closes those performance gaps.
Always. So the proposition is a relative value pairs trade. You go long CXM, and at the same time, you short the RGV software ETF.
Okay, lay out the rationale.
It's simple.
Yeah.
CXM's story has fundamentally changed. It's not a high-burn growth story anymore. It's a profitable, well-managed company with a 15% margin. A lot of the companies inside the IGV, they don't have that clarity.
So it's a bet on relative strength.
Exactly. You're wagering that CXM's proven operational leverage and their raised guidance will force the stock to close that performance gap over the next 6 to 12 months, even if the broader software market gets choppy.
A compelling bet on disciplined execution winning out in the end.
Prudence pays, even in software.
So to summarize this deep dive, Sprinklr delivered a really solid Q3 beat. It was driven almost entirely by financial discipline and margin expansion.
And those early results from Project Bear Hug seem to be real. That focus on their top customers is paying off, and you can see it in that 113% NDE number.
The foundation looks strong. The C-suite is built for this next phase.
Which leads us to the final provocative question for you to think about. Given management's confidence in their AI platform and their very clear multi-year execution plan, what level of subscription growth reacceleration is actually necessary? What's the magic number that gets them from 5% back up towards double digits? The number that finally convinces the market that they can be both profitable and a growth company again.
Because that acceleration is the only thing standing between them and a full valuation reset.